Hello, friends. Tony Warfield coming at you once again with a new training video, Life After 780. Meet Roy. Roy is an analyst, 34, married with 2 kids, and now he has his parents moving in due to no retirement income, and Social Security just is not cutting it. So now Roy's in a pretty bad credit mood. Roy could not get a car, even a place to stay without paying ridiculous interest rates, yet he needed to get a new family vehicle and home with his parents moving in. His car and mortgage is so expensive, he has to work himself to the bone. He never gets to see what's important to him because he's always working. He has a net monthly income of $6,000, and his debt to income ratio is dangerously high. And a good reason why, if you take a look at his credit report, he's got some challenges there: bankruptcy, various liabilities, collections, credit card debt, and a host of other things. But lucky for Roy, his friend's wife just happens to be a credit restoration specialist. So they meet, and she gets right on the job. 45 to 90 days later, he's starting to look a whole lot better. Bankruptcy, gone. Various liabilities, knocked out. Collections, disappeared. Credit card debt, reduced. His remaining credit issues are still there, but hey, they're a work in progress. So they continue to work together, and as time passes, Roy's FICO score continues to go up and up and up. And next thing you know, he reaches, you guessed it, 780. Good job, Roy. But what has Roy learned, really? So if we credit specialists do all the work to repair our clients' credit, they would be the same people with the same habits, just with a higher FICO score, which means they can revert to those old habits and end up right where they started. Too often do we help others rebuild their credit and expect them to know what to do once they reach their credit goal. We can only share what we know, so if we ourselves do not know what the next step might be, we cannot coach Roy or any other client to a more stable and successful financial future. So what does Roy do next? Well, most of us, including Roy, if you take a look at when he got his car, his payment was $673 because his FICO score is 588. And his house was $2,839 for that same FICO score because he had to get a larger home. But of course, now that he has that nice, hot and sexy 780, he's saving about $146 a month on his car, $798 on his house, with a net savings of $944 each month, or $11,328 a year. But I got to ask you again, what's next? So they didn't tell us anything about the ways of money when we came up. Where was the financial information we needed to help us avoid life's financial pitfalls? Far too many of us, even our parents, did not know. This is why so many people are struggling and have little to no retirement income. We had to learn the hard way. I know I did. This is often a primary reason why we cannot move forward financially and need the services of professionals to get us back on track. Roy will need to learn how money works in addition to restoring his credit so he can stay on track. To do this, he has to unlearn old habits, retrain the mind. And just like with any good training video, there's a test. So say you have $10,000 in a portfolio account and the market drops 50%. Naturally, you end up with just $5,000 in your account. But what happens if the market goes back up 50%? How much money do you have in your account? I'll wait. Okay, so if you said you have $10,000 in your account, you'll be absolutely wrong. And the reason why that is because 50% of $5,000 is $2,500. So your account will end up with $7,500. You would have to increase that account another 100% just to get back where you started. Conversely, if you had that same $10,000 and the market went up 100%, you'll have 20 grand. But if the market only dropped 50%, you'll end up right back where you started. And that is something that sometimes it's hard to understand, but in time, you'll figure it out. But there's one more thing I'd like to share with you. People usually have a tough time understanding interest. So we basically have 2 types, simple and compound. So simple interest is basically earning interest on the principal that you have in your account. So in this case, $1,000, if you earn 10% on that $1,000 every year, you get $100 added to your principal every year. Correction, $100 added to your account every year. So the first year you get $100, you got $1,100. The second year you get another $100, you got $1,200, and on and on and on. After 50 years, you got $60,000. Scratch that, $6,000. Man, it sounded a whole lot better before, didn't it? But if you look over at compound interest, that's your principal plus the interest that's earned that you're earning interest on. So your first $1,000 gets 10%. So now you're at $1,100. The very next year, that $1,100 gets another 10%. So now that's $110 added to that $1,100. So now you're at $1,210. And this continues to compound over the years. So in 50 years, that $1,000 ends up being $117,000 and more. That's a big difference from that simple interest. So when you look at that, you can understand why when you buy a car, you know, the car might have been $20,000, but if you keep that car for 5, 6, or 7 years, you've actually paid $40,000 for it. Compound interest is why that happens. If you look at a house that's $250,000 and you end up paying $450,000 on it on a 30-year fixed, that's because of compound interest. But compound interest is not always your enemy. Compound interest can also be your friend, especially when you have an investment account. So that's something we want to talk about in more detail later. So, of course, now that his credit is fantastic, he needs to learn a few more things. So he needs to talk to a financial professional to help him learn how money works. So as soon as he gets that training started, right out the bat, he learns about the financial industry. So you want to put your cash in a bank account. Why? Most people do. It's for safety, liquidity, but you have low yield. And the spending power depreciates as inflation increases yearly. Your principal amount loses value each year, plus the fees that you have to pay on that account. So there are also people who like to invest their money. Why? Because it's a great rate of return. But if the market were to crash, you stand to lose everything that you had in the account. One of the best things I tell people is to follow the banks. And the reason why that is banks actually have people that they hire to tell the population what to do with their buying and sellings of their stocks. And I'll give you an example of that. So say the bank has 500,000 shares of widgets and they want to sell those widgets. So they tell their financial gurus that are on the radios and on the TV to tell everybody to buy these widgets. The bank wants to sell them and they want you to buy them. So they go, hey, this is a hot buy. These widgets are $100 per share. You need to get them now because they're going to go up, 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 up. So the first thing you do is you run out there and you go ahead and get yourself, several shares of these widgets. So the banks is selling these widgets at $100 a piece. Now they flood the market with all these widgets. So it's high supply, but low demand. So what happens? The price of those widgets just starts to tank. Next thing you know, it goes down to $10, right? So what do you think the banks are going to do? The banks want to buy those shares back, right? So they tell their people to tell everybody, you need to sell, sell, sell. So now the bank is buying all these widgets for $10 that you bought for $100. So who makes out in that? So the best thing that you can do is just follow what the banks are doing. And then there's life insurance. And life insurance, in my opinion, is the best option because it has a tax advantage protection. So you definitely can protect you where you can pay your taxes now, pay your taxes later, or not even have to pay your taxes at all. And if you have the right type of life insurance, you have cash accumulation, you can collateralize for your own needs. So you can take out a loan against that life insurance, and you can use that money for whatever you want to use, business purposes or personal purposes. So there are 4 steps to create financial strength. Pretty easy to understand that. So manage your money wisely. Don't spend more than you make. Common sense, but common sense is not so common. No living off credit cards. This is like a monthly personal loan at a ridiculous interest rate. This is not your money. So you want to make sure that you pay off your balances every month if you can, of course. You want to create an emergency fund, for 3 to 6 months. So right now, the recording of this video is April 30th, and we're still basically in a quarantine. And that 3 to 6 months is a big deal for a lot of people if they had the ability to do that, because it's really carrying them through this time. And for those of you who are still working, thank you. But it's definitely something that's essential for you to continue to take care of your family. So you definitely want to consider that emergency fund as soon as you get yourself in a position to do so. You want to set financial goals, 1 year, 5 year, 10 years. And the reason why this is important is if you have the monies allocated for your goals, you're less likely to waste that money on something else. So that's important. And once again, manage your debt, going back up to those credit cards. It's important that if you can pay it in cash, pay it in cash. Because what happens is if you continue to charge everything, or you continue to put anything on payments, you're going to have to pay for that thing. So we want to be very, very limited on how much debt that you accumulate. You want to protect your income and your family, life insurance. You want to accumulate assets. But before you can accumulate an asset, you need to know what an asset is. Assets make you money. Liabilities take your money. For example, many of you might think that owning a house is an asset. If that house is not making you any money, it's a liability. Even if you own the house, you still got to pay property tax. You still got to pay for upkeep. So if any property or anything that you might have is not putting money in your pocket, then it's a liability. If it's putting money in your pocket, then it's an asset, even if it's just $1. You want to preserve your legacy. And there are several things we can talk about, but my top 4 would be adequate protection, life insurance, long-term care costs. If you're someone that's over 50 right now, long-term care is a big deal to you. And there are different policies out there to protect you as you get a little bit older. You want to make sure you have a power of attorney and living wills. And the reason why that is something happens to you and you can't speak for yourself. You want someone to be the executor of your estate to be able to make sure your wishes are carried out. That's something you want to jump on now while you're healthy, because when you're not, that's not going to be something you're going to be thinking about. So what kind of life insurance types are there? So you have a term policy, which is basically like renting life insurance. And the policy periods are usually anywhere from 10 to 30 years. But after that 30 years is up, the life insurance is over, or you have to pay a ridiculous premium to be able to keep that. You also have permanent life insurance. That's like buying a house. You have whole life, universal life. Different types of universal life would be flexible, variable, and index. We'll talk about that in detail in another training. So what is a term policy? How do you break that down? Advantage of a term policy you can cover financial obligations that will disappear over time, such as a mortgage or college expenses. When you are young, the premiums are generally lower than the cost of cash value life insurance or permanent insurance. A term policy can be convertible to permanent, depending on the carrier and time of policy. There are some things that might be considered a disadvantage. Again, though, it provides protection for a specific time period, not for life. The premiums increase when the term is over and your health may have changed. The reason why this is significant is as you get a little bit older and say you have an illness, that's going to be charged towards your premium. So your premiums would be significantly higher. Policies do not usually bill cash value. They never do. So I know what you're thinking. What does a term conversion work? How does a term conversion work? Well, each term conversion rider has an expiration date, which varies by company and product. You have until this expiration date to convert your term policy into a permanent policy without needing to go through underwriting again. However, your age is factored in. Your premiums will change and your paid-in premiums can be credited to your account. So the term policy, if you were to keep the term policy and allow it to lapse, then the term policy is gone. But if you were to keep the term policy and then accept the new premiums, the premiums will be considerably higher because they'll be taking your age in consideration, just like if you were to get that permanent policy. But the difference is the premiums that you put into the term policy, if you convert, you'll be able to have those premiums put into your permanent policy, and you can use that as collateral for your business or personal use. I know you're going to have more questions. Give me a call. Let me know. So let's talk about a permanent policy. The advantage is if funded properly, will provide protection for life. If funded properly, premiums will not increase. It can accumulate cash value and be withdrawn income tax free. Now, the money that you put into a life insurance policy is basically the principal amount. That money cannot be taxed. It's already been taxed. It's after-tax funds. But if it accrues interest, that can be taxed. We'll talk about that in another video. This Could be supplemental income for retirement. Accumulated cash can be used as collateral for business and personal use loans. Your money remains in a policy maintaining its growth potential. So what does that mean? If you collateralize your life insurance policy, meaning that you want to be able to borrow money against that life insurance policy, the money that's in your account remains in your account and you're borrowing money from the insurance agency, just so you know. Some disadvantages: if canceled early, there is usually a large surrender penalty. Surrender charges can apply for time periods as little as 30 days or as much as 15 years on some annuity and insurance products. You must buy the life insurance and also save money in a cash accumulation account. You cannot do one or the other. If underfunded, the policy can lapse, and that lapse is not going to be immediate. So if you have money in that life insurance policy, as that money is being exhausted paying for the cost of insurance, once it's completely exhausted, then the life insurance policy will lapse. So depending on how much money you have in that account, that lapse can be delayed for a considerable amount of time. So there are a few enemies to your money, and I'm sure you know what they are after you look at your paycheck every month. Inflation, taxes, and risk. Quite simply, the inflation is basically what cost a quarter then cost you $2 now. I remember I used to eat this cake from Hostess called a chocodile. I used to get them for a quarter. And even though they changed the recipe now, I'm pretty upset about that. Now it's $2. It's crazy. So you can imagine that whatever the strength the dollar has today, it's not going to be as strong tomorrow. So you want to make sure that you put your money into an account that's going to be able to outpace the current rate of inflation, 3.2% to 4% every year. Another enemy would be taxes. Now, this is something that's everyone's friend, I'm sure. Most people have heard it said, but you know, the only thing that's certain is death and taxes. For example, if you have a large estate, when you pass away, the value of your estate above an exemption amount is subject to an estate tax. This means some people can't even avoid taxes when they die. While many realize that the state and federal taxes take a large bite out of their paychecks, most people don't realize that there are taxes for more than just the money you earn. An important part of accumulating assets is to plan a strategy to minimize the effect of those taxes and your financial goals. So here's another test. What do you think? Refund, you owe the IRS, or you break even? What do you think? I'll wait. Well, I got an opinion. So I think a refund is a bad idea. And the reason why that is because you probably need your money during the year. But while you're overpaying your taxes, that money is going into an account that's earning interest. So when you get your refund, you get the principal amount that you overpaid, but you don't get any of the interest that you earned on that account. The government keeps that. Now, conversely, if you owe money and you are late on your payments, that also earns interest, but it earns interest for the government. And guess what? You have to pay what you owe plus the interest because you're late. So the best thing to do is break even. Pay what you can and make sure you're within a couple of $100 plus or minus so you can have your money during the year and you don't have to worry about a big tax liability at the end of the year. So what is market risk? With everything, there's some kind of risk. You walk out the door, there's risk. But financially, there's a lot of risk depending on where you put your money. One factor that most people do not consider carefully when investing their money is the concept of risk. Market risk refers to the possibility that the value of your investment will go down because of changes in the broader economy that you cannot control. Examples of these changes include stock prices, interest rates, currency exchange rates, commodity prices, and many other factors. So, you know, a lot of people, they ask me, well, Tony, what should I invest in? First of all, you have to make sure you understand the concept of risk, because if you can't handle the possibility of losing money, then that's going to put you in one type of investment situation. If you can handle that market risk, to just play money, you can handle a volatile market, then that's going to put you in this another type of investment strategy. But it has to be something that you understand, that whatever money that you put in, you have a great potential to gain, but you have an equal or greater amount of potential to lose it. So One of the best things that I said would, for you to be able to put your money into would be, like I said, life insurance. There's four functions of life insurance: protection, where you get the death and living benefits. Medical insurance does not often cover everything. Where it falls short is your policy can prevent you from leaving your family bankrupt. Now, as a Black man, that's especially important to me because even though the Black community actually does have more insurance policies than any other community, those insurance policies are 10,000, 25,000, 50,000, and they're basically called burial insurance policies. But they might pay for the burial, but they don't pay for everything else that you might have left your family to deal with. So you also have accumulation, tax deferred, cash value, and you can basically be your own bank. Imagine if you have a life insurance policy and you needed some money, instead of going to some other bank, you can just borrow money from yourself. And when you're ready to pay that money back, guess who you're paying back? You. Big deal. Income. How about tax-free income for retirement and to supplement your Social Security insurance? Now, we understand that Social Security was not intended to be the payoff for you. It was only supposed to be supplemental. And because you have so many people drawing from Social Security right now, with all the baby boomers basically retiring over the past couple of decades, you can imagine that Social Security probably will not be there for you with any great strength once you hit retirement age. And then there's their wealth transfer, income tax-free death benefit. Now, my God, I hate to be morbid, but I got to say it. So every one of us is going to answer God's call. We all are. But unfortunately, many of us, when we answer God's call, we leave our family not in a better position than when we were alive. So a good example of this is, how many times have you driven down the street and you see people standing on the corner holding signs looking for donation to help them bury their daughter or their brother or their friend or their mother? You know, that is a very hurtful thing to see. But, you know, I had a friend of mine, and she said something to me that was very profound. You know, someone had asked her to help her bury her father. And with as much grace as she can give her, she said, why would I take my money away from my family to help you cover a responsibility that you should have taken care of on your own? And on the surface, that might seem heartless, but you know, when you think about it, it makes sense. Because if you spend all your time not taking care of your responsibilities, not making sure your house is in order, at some point, that's going to come back and bite you. And I definitely would not want anyone to be put in a position to where they feel like they have to take handouts from anybody. So making sure you have something to leave your family so they do not have to suffer the indignity of having to ask for help to bury their loved one, I think that's the best blessing that you can give them. So what are the uses of life insurance? It's income replacement upon your breadwinner's death. You can prepare for college, pay off mortgage, business, and personal loans. You can get tax deferred and tax advantage concept for retirement. And basically, life insurance can really cover a lot of things in your life. So let's see how Roy's doing again. Roy is now educated in the ways of money. With this newfound knowledge, he wants to focus on building a legacy for his family and continue helping his parents. He now has $11,000 yearly to work with. So what should he do? So if you go back to those 4 steps, a couple of key points would be, he wants to set financial goals, make a plan on when he wants to start his business if he decides to do so. He wants to protect his income and accumulate assets. All he needs now is to preserve his legacy. So how will he do that? Life insurance. At 34, Roy is still super young. He has $11,000 a year extra to work with. So he has a few options. He can get a term policy, let's just say $500,000, with a death benefit and living benefits that'll take care of him if he gets sick. And the reason why that's significant is, if he's the primary breadwinner in a family and he cannot produce that income, having a living benefit that'll be able to cover that for as long as he's sick is a big deal. He can also get an index policy for a couple of $100,000 with the same death benefit, a couple $100,000 death benefit and living benefits, to accumulate tax-free income when he retires. Money that grows in an index account that offers gains and locks in when the market drops. So I want to go a little bit further with that. So imagine putting your money into an index. A lot of people know about the S&P 500. So when you put your money in this index, the whole idea behind putting your money in this index is as the market is doing well, your money is going up, 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 right? That's great. You don't have a problem with that. But when the market tanks, your gains get locked in. So what does that mean? Say you got $100,000 and over the next couple of months, you've earned about, earned a couple of thousand on the account. So now you have 102,000, 103,000, 110,000, 150,000, whatever. And the market all of a sudden just drops. Well, when the market drops and goes like 50% or whatever, you still have $150,000 in your account. So when the market continues to go up again, guess what? Your money continues to go up again. Now, I will tell you that, the market might go up 27%. And with an indexed account, that account is capped, say 13, 14, 15%. So you might not get the full measure of the increase, but I would rather take 15% and be happy with that versus my entire account drops 50% and I lose from 150 to 75,000, then I have to start over again. So that's the name of the game. You don't want to have to start over again because you can't make up those losses. But if you haven't had any losses, you can continue growing your account and then your retirement income will be assured. So a couple of benefits that I would like to talk about for Roy's legacy for his children is his policies provide tax-free money for college. His policies for retirement income, once he reaches a certain age, there's no need to depend on his children. His cash flow for those unforeseen events requiring large cash sums will be there, and it'll ensure his family is still financially stable should he become ill. So now Roy can breathe a sigh of relief as he no longer has to worry about how his family is going to be taken care of should he no longer be able to contribute. That is financial success to me, people. I remember when back in 2001, I lost too much money. We don't want to talk about that. In 2008, it happened to me again. And, as I continue to get older, I realized that my marketability started to diminish. It was starting to diminish. I don't want to say started. But because of that, recovery time becomes critical. So I didn't know anything about life insurance at the time. So when I got a chance to learn about it, it was a big deal to me. And when I realized how even in death, I can still secure my family, I got really excited about that. So that's something I want you to consider. So you got to get what works best for you. Depending on your age and health, the type of coverage that will benefit you most might change over the years. Modifying your policies will help you stay protected as you age. So give you an example of that. Let's just say there's a 20-year-old young lady whose family history, the women usually live in their 90s. Would a 20-year term policy benefit her? Now, a lot of people might think, well, if she's 20-year-old, why would she get a 20-year insurance policy? Because she'll be 40 and it'll lapse, right? And her family lives to be in their 90s. That's true. If you just put that on paper, that's exactly right. But here's the deal. She's 20. She's not that financially solvent yet, but she still wants to get insurance. So it's better for her to rent that insurance so she's protected in the event something happens. And when she's financially more stable, she can go ahead and get another policy to help her build cash value. And that's how flexible life insurance really is. So being able to learn about how money works will jumpstart your financial knowledge, arming you with the information to take control over your financial health. What was shared in this video was only a sample of the information available to help you make the financial decisions for you and your family. You need someone to count on because your family counts on you. So you can contact me anytime. Feel free to call. Live abundantly, live passionately, live purposefully. And with that, I thank you for your time. You guys take care out there. Be safe.